Hi, I'm Mike Caldwell. I'm the Director of the Business Innovation Zone. The Business Innovation Zone, or the BIZ, was created to help high-growth potential entrepreneurs and businesses in central Iowa. We provide a variety of services, including mentoring, consulting, counseling, validating business models, and help with access to funding for high-growth companies. We offer also a number of networking opportunities, including luncheons once a month and all-day seminars on subjects such as marketing and finance. You can find out more about the BIZ at www.bizci.org.
So, topic is due diligence today, and maybe a little bit of background would be helpful to kind of set the context. I run a small investment banking practice at Dewey Financial Network, which is our broker-dealer, Dewey Investment Banking. We work with companies anywhere from generally 1 to 100 million in revenue. We help them with their capital formation. We help them with mergers and acquisitions as well. So we're not really industry specialists in any one thing. What we understand are the life cycle needs of companies at that small to lower end to the mid-market range. That's where we really focus on. We've got Dewey Investment Partners also, which is a $10 million venture fund. We've made 7 investments so far. 6 of them have been in early stage software companies, and then one of them is in a biopharmaceutical company as well. So that's a little bit about what I do every day and the firm that I'm with. The topic is due diligence, but really underlying that, or capital formation, or pitching for investors, valuation, all of that at the end of the day. Underlying all that is about innovation. It's about creating something new. It's about setting yourself apart in the market, attracting investors if that is in fact what your objective is or not. But it's doing something unique that will create some kind of a new business out of it. So innovation is a pretty important thing, and as you may have read in the paper today, it looks like our governor is trying to stimulate more innovation with some new private-public partnership to replace IDED. So if the state government can innovate, which I'm not holding my breath on, we can too, right? So I thought I'd share a couple, just real quick, some perspectives on innovation. So these are some quotes here. Everything that can be invented has been invented. This was in 1899, the commissioner of the U.S. Patent Office. Right. Let's see here.
Yeah, an Android or an iPhone?
Exactly. There's no reason anyone would want a computer in their home. That was in 1977. Actually, going forward, we may not need computers in our homes with mobile devices, so maybe that will be like your old grandfather's ties. At some point, it'll come back around to being in style. We'll see about that. A couple others here real quick. So this was said in 1895, heavier-than-air flying machines are impossible. Okay? And then in 1949, Popular Mechanics, computers in the future may weigh no more than 1.5 tons. So obviously, innovation has led us a long way, thankfully. Well, a lot of people think of diligence as an event, right? To get to here, to have the buyout, or to get the money, or to make the acquisition, or whatever, it's an event. You got to go through it. It's a gating item. And we're going to get into some of the real not sexy sides of diligence, just so you can understand what it involves. But to keep it in perspective, diligence is really more of a process than an event. It starts on the first day, really. It starts with the pitch. It starts with, it's like buying a house. You start gaining impressions of this house that you're interested in buying the first time you see it on Craigslist. Who's it listed with? Who's their broker? What kind of information? Is it organized? Does it look nice? Is it sharp? Is it in color? Is it not in color? And then, you further refine that by doing a walkthrough in the house, getting the disclosures. So just like buying a house, the process of diligence is really about, it's an opportunity to promote what you're doing. And it starts at the very beginning with the pitch, with the first time that you come in contact with whoever this potential business partner is. And for the context of our discussion today, maybe just focusing on the capital raising side of it, if that's all right. So it is a process, not an event. And as such, you're always wanting to put your best foot forward. You want to be prepared. You want to be organized. If there's an extensive list of things, then how well organized you are, how quick you can respond, all says something about your ability to operate the business. Or at least those are the conclusions that could be inferred. Sloppy, papers all over, I got to go do this, documents that aren't signed. All of that suggests that maybe this isn't the kind of thing that I want to be involved with. So there's a lot of mechanics as you get into diligence. There's a lot of mechanics that we'll talk about today. But from a big picture, keep in mind that it's really more than just that event of actually producing the documents. It's what you're doing to promote yourself. It's an opportunity to market yourself. You're dating. You're starting to date. And so it starts on that first date. It starts with the first email that you might send. So keep those things in mind as you're doing it. One quick point about non-disclosure agreements. If you're asking from an institutional investor, whether it's a VC or some kind of an organized entity, venture, private equity, or some other corporate or strategic type investor, you're welcome to ask, don't expect that a non-disclosure will be signed. We're in the business of making investments. We see hundreds of business plans a year. It's, okay, are we interested? How did this get to us? You know, maybe spend some time on the phone, yay or nay, and it's in the pile. Or it's on the other pile. So we're not in the business of trying to steal intellectual property or recreate anything that you're doing already. We're just looking for really good businesses to invest in. And if we signed an NDA for every business that we looked at, we could be backdoor tripping ourselves up 3 to 5 years from now because we've agreed to not do this or to do this, and there's no compliance because there's just a mound of these documents to try to keep track of. So anyway, like I said, your business is very important, absolutely, but everybody else's is as well. And if you don't really trust the people that you're talking to, then maybe you ought not be talking to them in the first place. Like I said, individual investors or angel investors, that might be a different scenario, although they're probably not that big of a threat to you anyway, but it's a lot more possible in that context. And you're always welcome to ask anybody to sign it, just maybe have your expectations managed along the way. So in the first section, it's your corporate records and how the business is organized. At this point, again, I'm looking at it from an investor's perspective, and you should be sitting here thinking, I'm trying to get somebody that's wanting to put capital into my business, or maybe there's somebody that wants to buy my business later on, or there's some kind of a licensing agreement and there's due diligence going on. Licensing probably wouldn't get to this level, but where there's some kind of ownership being exchanged, you can expect to get into this level. I'm going to look at the articles, the bylaws, what the corporate documents look like. Are there standard provisions in there? Are there protective provisions? Protective provisions, could scare me off if there's, could scare off a potential investor. But of course, I'm going to ask for them when I put my money in. So these are the realities of this, right? How the business is from a head count perspective, do you understand, what are the different people you have in your business plan to execute, in your org chart to execute the business plan? How well is it laid out? Is the reporting structures all there? Who your board is, that's a really important piece. Obviously, not just from a governance perspective, but boards can really be valuable from a strategic side. And one thing that I've seen a lot of early stage companies do that is a really good idea, or at least I found it to be a really good idea, is when you don't have your board set up yet and you're kind of in your early days, put together some kind of a strategic advisory board. You don't have to give up any ownership generally. You may have to pay them something, give them some options. But these are people that have an interest in seeing you succeed. So if you know that there are blind spots, or if you, in your own skill set, or you are trying to tap into a market that maybe you have the technical expertise in, but you may not have a view of the landscape. You don't know what the competitive forces all look like. How do I do this really differently? there are opportunities to build credibility by incorporating other people on the outside that don't really cost you, anything potentially. So early stage companies that I see where there's a really well written business plan, and I see, strategic advisors, and that's an acknowledgement that you're really trying to put all these pieces together, and you can borrow credibility from that as well. So you may not be ready for a board yet, but maybe some kind of a strategic advisor group, which at the end of the day are just mentors, formally organized. But the nice thing for them is they don't have any fiduciary risk that a board member would have. But to the extent that you have some early stage folks that are friends, that are mentors, that can help provide that guidance, they can be converted later on into board members. A lot of board structures, and I guess we don't need to get too complicated with it, but 3 to 5 person board structures are kind of common at the early stage, probably 3. Maybe the most common is none. But to kind of move your way through as the company evolves, having 3 members on the board, maybe 5. You often want to keep the management-related board members to 1, possibly 2 seats, and then the rest are going to be potential investors that you would bring in. Depending on how many there are, they may want 1 or 2 seats. And then you could have some more strategic help through 1 or 2 seats, depending on how many seats management has or the investors have. Again, the quality of how things are documented. Are the minutes signed? Do you have all the signatures that you need? Are they organized? Do you have the minutes actually from the meetings from 3 years ago? Can you produce them quickly? As I said in the first slide, style points count. Complexity. Do the way the business is structured now facilitate an investment? An example there is a lot of venture investors don't like to invest in LLCs. They like to invest in C Corps. And they don't like, generally they won't invest in S corporations. So as you're thinking about incorporating, if you haven't already, or you are incorporated and you're a pass-through as opposed to a C corporation, and you're going to seek investors, you may want to keep that in mind. If it's your company and it's your money, you can do whatever you want. Even if you don't bring in outside investors. Even if you don't bring in outside investors, however, you may want to consider, though, doing things cleanly from the beginning, because if you have any intent on growing the business or exiting the business, selling it to somebody, these are all questions that the buyer will ask. So regardless of whether you're actually seeking to bring on investors now, these are still things to keep in mind if you intend to sell the business later on, because this is what they're going to ask for. It's when you're bringing in other people's money that governance matters a lot. So like I said, anybody can run their business the way that they want, and you don't need outside investors, and oftentimes we tell people find ways not to take the money. Do it yourself. Bootstrap it, use non-dilutive forms of capital, raise friendly money that's at friendlier valuations. Do that first. But to the extent that you do end up bringing in, institutional money, then governance is going to be a big deal. So whether you're doing it now or are you preparing for it later on, is really a function of how well are you operating your business on a day-to-day basis. Do you have a board? Are you having regular meetings? Are you documenting those things? Are you following all the right procedures? We just went through a situation where one of our portfolio companies invalidly called a shareholder meeting. Well, it's not undoable. We can clean it up. But if you foot fault on things that are less material, what happens if you get into a real situation later on where somebody wants to write that big check, or somebody wants to buy your business, and there's a foot fault then? When there's other people's money involved, you're a fiduciary of their money. And so it's a partnership as between the investor and the owners of the company. Conflicts of interest, you deal with things like, if it's my business, is my sister in the business? Am I paying her? Am I going to pay for her apartment also? Those are all fine things to do, but you have to disclose all of them in advance to the board. On sales and marketing, depending on your stage, this will be the most important part. At least it is from our perspective. We want to know that you know your business and your market. We want to know that you know how you're going to acquire customers. Because at the end of the day, it's all about making money, right? So we want to know that you know how to do that. This is where you demonstrate that you know how to do that. Or that you know that it's also important to know what you don't know. And it's okay to say, look, this is what our market is. These are what I believe our strategies are. These are what I believe our tactics are. But we're going to need to hire some people because we can't do it based on the current staffing. That's fine. We'll put in an additional $100,000 and you can go find your VP of sales. You don't have to have it all perfectly packaged up with a bow around it. You can, that's part of what bringing on particularly smart money that may cost you more, that may have more of an impact on your valuation. You may think it's worth $10. I'm going to think it's worth $5. But I sit on 6 boards of software companies. And if you're a software company, maybe I can add some value at the board level. So there's a trade-off. If you bring on a friends and family at $9 a share valuation, are they going to bring any strategic value? No, so then you don't need to pay as much for it. Does that concept make sense? So this is a really important aspect of it all. Do you know who your customers are, what your value proposition is? Do I need this? Do I really, really need this? Is this an iterative change, or is this something that's going to be a game changer? What did Mark Andreessen said? He said, don't invest in anything that's iterative. Andreessen Horowitz is a big venture fund. Mark Andreessen, the founder of Netscape, I believe is what it was. Nothing iterative. Don't do anything that's just, a slight modification to something to make it a little bit better. Not a process improvement, something that's actually new and different. One of the things that we look for also on the sales and marketing side is who your people are. And again, you don't have to have everybody on staff right now. But if you're selling, plastic bottles of water through channel, you want to know, have you sold anything in plastic bottles before? I don't care if it's water. Have you sold anything that's bottled in water through a channel? So if I'm evaluating the sales talent or the marketing talent, I want to know, have they done something that's on 1, 2, or 3 levels similar to what you're going to be asked to do or what they're being asked to do right now? It's what the relevance of their experience is. It's a big indicator of future success if they've done it before. A lot of the best people you can hire are those people that have made mistakes. People that haven't made mistakes and haven't fallen down and skinned their knees and gotten back up are not as battle tested as those that have. So the evaluation is, have they learned from those and have they had the opportunity to really demonstrate that, okay, that's fine. None of us are perfect, right? But have we learned from that, and here's how I did it differently later on. So no, failures is not a disqualifier. In fact, it adds a lot of character. Some of the intangible things that you look at could actually, be a reason why you'd hire somebody. How much revenue are you going to have over what period of time? What are the assumptions? Make a lot of those assumptions, and please, 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 don't say, well, it's a $500 million market. All I need to do is capture 2% of it, and we're going to be making lots of money. Please don't do that. Please don't do that. Build it from the ground up. Here's what our target market is. Here's a rational pricing model based on what we see others in the market charging right now. Based on these people that have these experiences, I think we can sell 50 widgets over this period of time, and that's going to generate this much revenue. Hey, that's building it from the ground up based on facts, right? That's the way that you want to see it. So just whatever your thought process is, make sure that it's fully articulated and explained. Range of expectations, so sometimes this can mean you do a good, better, best case scenarios. What we can all guarantee is that whatever you put on paper is going to be wrong. Is it going to be wrong this way? Is it going to be wrong this way? Who knows? No investor expects you to hit those numbers exactly. We all agree it's not going to happen. But this is about managing expectations. This is about how well do you know your business and how well, after we give you this money, are you able to do ABC with it? Because you said you were going to do ABC with it. So, overpromising gets nobody anywhere, and it'll make you look bad. So a range of expectations, good, better, best. You know, they don't need to be that complicated, but somehow sensitized to, well, you know what, if we get this contract or we get this channel partner to kick in for us, it'll make this much difference, and here's why. Okay, well, that may be a best case. What do some of the other cases look like? Again, it's how well do you know your business and how well are you managing expectations. You're getting into a relationship, so you kind of want to manage all of that. It's like I told my wife, if you expect me to do 50% of everything around the house, you're going to, you know, you're setting yourself up to be poorly disappointed. Have that conversation early. Looking at your financial statements, obviously, you're going to want to look at the statement of profit and loss, your income statement, balance sheet, cash flow. This becomes a little less relevant for early stage companies, obviously, because you don't have much of anything other than maybe expenses. That's fine. But what we really want to understand is how, you know, particularly if you're in the software business, do you understand how that flows through into the income statement? You know, are you recognizing revenue the right way if it's a subscription model basis? Do you have, you know, customer contracts over a multiple year period? Are you getting paid up front? Do you have to amortize that over time and flow some of it to deferred revenue? Again, you don't have to have complex financial statements. You just have to demonstrate that you understand how they work in the context of your business. We'll look at expenses from the fixed or variable perspective. If you've got, you know, one way that early stage companies will, you know, effectively bootstrap is hire consultants or hire, you know, 1099 help. It's variable. If you get the contract, then you can hire more people and you can scale up that way without having to pay, you know, employee benefits, without having to worry about workers' comp, things like that. You can keep on a contractor basis. And if you don't get the contract, then, you know, you can scale things back. So are you loaded with a lot of fixed overhead? Is there some variable component to it? How flexible is the organization? On the previous side at the bottom, cash flow break even, what's your margin for error? If you've got $1.5 million fixed overhead that regardless of what revenue you do, you can't go up and down with your costs, you know, are you paying high base salaries for your salespeople versus a reasonable base and then some variable compensation to incent them? So the more revenue you have, the more commissions you pay out. That's wonderful. But if there's not the revenue there, you're still fixed paying a high base salary. That's not so good. So how scalable is it? How realistic is your cost structure relative to where you are in your business cycle? What's your margin for error there? If you don't hit that contract and you've got that high base salary, you're going to need more cash. How you report is how you govern. We are very interested to see right here these key metrics. Don't create a report for an investor that says, here's a nice dashboard from Salesforce, or here's a really nice graph on, you know, new customers by quarter and all this stuff. What I want to see, what investors want to see is how are you managing your business on a day-to-day basis? What are your conversion rates for customers? How many new leads? You know, how do you know if your marketing spend is worth it? That's really hard to manage. Well, track that, because those are things that you're going to want to look at before you make those investments. So again, metrics are there's a lot of data, but there's not a lot of information. And the information that really matters is what are you using to run your business with on a day-to-day basis? What's the cash flow report that you get? Do you get a cash flow report? Do you know where your cash balances stand on any single day of the week? That gets to your management style. That gets to how control of the business are you. Those are the things that we're going to be looking for there. Do you know them cold? Are you actually using them? Earlier stage companies don't really need to worry about having your statements audited. I would tell you that, you know, it's only when additional money from the outside comes in that you're going to want audits, or you get to a critical mass that if you want to sell your business later on, then that's a nice warm blanket. What matters is just that they're done regularly and then they're done right. So you can use QuickBooks, no problem. You don't have to hire a big name accounting firm. You can hire your uncle who knows how to use QuickBooks to do your books. That's fine, as long as they're good and accurate. Now, at some point you may grow out of that. and need to go to an accounting firm to have financial statements done. But even then, early stage, you're not going to get the benefit of an RSM McGladdery doing it for you, or a KPMG. Hopefully none of you folks are in the audience that work for those firms. Local firms for those work very, very, very well. Spend the money where you need to. Moving on to financing here, and Mike tells me there's about 10 or 15 minutes, so how's the business capitalizes their fundraising flexibility? Again, this is, if you're looking to bring in investors, how conducive is your balance sheet or your cap table? Your cap table is the chart of who owns what of stock. And there's different kinds. There's common stock, there's preferred stock. So how conducive is your capitalization? What the different classes of stock have different rights and preferences. How many are there? How conducive is all of that to attracting outside capital? For instance, we'll see companies that have gone through, you have your common or your founders stock, and then they'll do a Series A. They may do a Series B. They may do a Series C. We've seen Series E, Series Fs. All that means is that there's a lot of other investors in that cap table, and it's a mess. They all have different rights, different preferences. If you wanted to sell the business, you need a PhD in how to understand how these classes all interact with each other and the cost to do all that. Whoever generally the last money in is going to have all the rights for the most part. Is that too onerous to make another investor that wants to come in? Or are there changes? Do you get creative? There's a lot of detail around all of this, but the bottom line is that my advice to anybody at an early stage is keep it as simple as possible. You don't need complex stock issuances. You don't need to do a lot of options. You don't need to do a lot of preferred. Just keep it simple. To the extent you can bring early stage investors in as common, do that. Try to avoid going to any preferred stock as long as you can. It's not a bad thing, but from an early perspective, you really don't need to get that differentiated. It's early enough that they believe in you, you want their money, we're in this together at an early round, at an early stage. The investors may not go for that, but my advice is keep it as simple as possible, as long as possible, and to the extent you can bring in outside investors into a common round, that's great. The extent of what those anti-dilution provisions look like, there's different variations of those, but there's generally always going to be some form of anti-dilution protection. Preemptive right, yeah. You can go from, if there's an issuance of dividends, for example, there's no adjustment for something like that. That would be something that's, a little. So there's full weighted, and then you get, you get the other end of the spectrum. But having the right to protect without having to write another check, though. Yeah, preemptive rights is where you've got to write a check to preserve what you've got. But there are anti-dilution provisions that don't require that as well. And there's different varieties and forms of those. Yeah, so like if there's a stock split, would a stock split be covered by an anti-dilution provision or not? It could not be. The issuance of dividends, is that an anti-dilution trigger, yes or no? From a financing perspective, there's how conducive is your cap table, is the balance sheet to bringing on new capital, whether it's equity or debt. Who's in your cap table? Do you have, 100 individual investors, or do you have one institutional investor? Sometimes that matters to folks, sometimes it doesn't. But what really matters is, what are you going to do with it, right? Have you thought about how you're going to turn my money and yours into something successful later on? So, what is your exit strategy? How are you going to use this capital? Yes, there's the business plan, but let's just say you execute your business plan as you think. Who's going to want this? Why? When? How much? What are companies paying right now for similar businesses like yours in the market? Has there been a lot of financing activity in your space? Has there been a lot of acquisitions that have happened of companies in your space? If there's not a lot of financing activity, not a lot of merger and acquisition activity, that's going to lead me to believe that if I invest in your business, there's a good chance that I'm not going to be able to get it out, no matter how successful you are. As an investor, I want to know those kinds of things. So again, we've talked about this one on taxes and the material agreements. Is the company structured in a tax-advantaged manner for both the operations, investment, and exit? So this gets to our discussion earlier on about, do you want an S Corp, an LLC, C Corporation? I did say that auditors are kind of a later on down the line thing, and that's true. They're not just for now for a good fiduciary, but they are good for a buyer. The other thing about, just kind of like Christian had mentioned earlier about the process of going through due diligence, the process of going through an audit, you actually learn quite a bit about your business. So there can be some added value there, but generally you do the audit when you need the audit. Material agreements, do you have your real crucial agreements formalized or not? So if you're creating intellectual property, if you're coding software, do you have employees that are doing it for you? Who owns that? They're your employees, but maybe with some of their ideas. Do you have an inventions rights agreement that says if they leave the company, it's still the intellectual property resides with the company? Employment agreements, option plans, non-disclosure agreements, any strategic relationships, channel, license. Don't do handshakes, particularly if you've got other people's money, but even regardless. Don't do anything on handshakes, get it documented, do it the right way. Can third parties impact your business? With licensing agreements and distribution agreements in particular, so if you've got a channel partner that is going to maybe give you 20% of the revenue that they sell to you, what are the performance requirements for that for them? Do they have some minimums that they need to hit? Do you have things that you need to do developmentally to be able to honor those agreements? Again, if you've got critical business partner relationships that could affect revenue, or there could be some, trip-ups later on, you want to be sure that all that is very well understood and documented up front. You can hire your sister to work in your company, and you can pay for her apartment. You just got to make sure everybody knows about it in advance. Disclosure is the point there. And if I'm doing diligence and I see that there's a lot of that going on, I may wonder, how good you are about managing cash. If you're making sloppy choices like that now, you may still make sloppy choices, after we've invested. So you may think twice about doing it, even though it is your company and your money. Intellectual property. Some companies will intentionally not protect their intellectual property. Be silent, don't draw attention to it. There's some merit to that argument. Many times, though, it makes sense to protect it. So you got to have good IP counsel do that for you. Don't do anything online. Just go to people that know what they're doing. Is all the intellectual property assigned to the company itself? Again, if somebody leaves, can they take it with them, or does the company actually own all of the IP? One of the things, though, that is really, you can spend, it's a balancing act on intellectual property, how much you spend on defending your intellectual property. I've seen companies spend $50,000 before they have $50,000 of revenue. That seems a little out of balance. At the end of the day, the best protection that you have is a viable business. The best protection for your intellectual property is going to be sales. It's how penetrated in the market are you? Do you have mind share? Do people know who you are? Do you have the market share? If you're seen as the incumbent and the leader, and you become really sticky and you're the de facto leader, somebody could challenge you, but at the end of the day, you've got the market share. So I would encourage you, as you're pursuing your own intellectual property strategies, don't forget to focus on the core business itself and having that be pretty viable. There are these other matters here: employee, deferred comp, benefits, insurance. If you have a board, you have directors and officers insurance, do you have property casualty, all those things. There's a lot of checkbox stuff here that aren't very strategic in nature. But litigation, have you had any? Have you been sued? You got to tell us about it. And then there's always the omnibus miscellaneous category where, you know, if you don't tell me something, lies of omission are still lies, even though you weren't trying to hide something. So it's better to, you know, share everything, you know, more than what you, if you were sitting in the other person's chair, what would you want to see? Everybody excited to go through due diligence now? That's it. That's all I got. Any questions on any of this? Like I said, if you want the our due diligence list, I'll leave some cards here, or get my email from Mike. It's aclaypool@dewayfinancial.net.